So welcome. I am Adam Pearl. I'm President and CEO of ArtPride New Jersey. For those of you that I don't know well, but there are so many familiar names on our participant list, and we're so glad that everyone could be with us this morning to have a really important conversation. We hope that you learn a lot this morning. Real quickly, I'll just say in terms of housekeeping, for those of you that are joining our call for the first time or the Zoom webinar, attending a Zoom webinar for the first time, the only people you're going to see on the screen are the panelists and presenters. And if you have a question, at the bottom of your screen, there's a Q&A button, and you can post that question, and we'll do our best to either answer it in that chat feature or bring it live to the speakers. There's also a chat feature where you can send notes to each other during class and not get in trouble by any of the teachers. And you can send notes to the panelists and to the whole group. You can also raise your hand in the participants, but if you have a question, you can put in the Q&A. That's usually the most effective way for us to manage everybody's questions. And with that, I am going to pass it over to Anne-Marie Miller, always with us, our Director of Public Policy and Advocacy.
Morning, everybody. It's Friday again. Welcome to week 7 of ArtPride's Arts Advocacy Update webinar. And of course, as usual, my screen is going to freeze. So there's something about Zoom. So I'm going to give you, while I'm keep pressing the enter button, what's happened since last week. On a federal level, the big push by House Democrats is to include state government relief in the next CARES Act stimulus. Also included is expansion of the earned income tax credit and the child tax credit. However, the Republicans want business liability protection for businesses as states start to reopen their economies. And I apologize that for some reason I'm going to do this stop share and then try again and see what happens. Okay. Nope, not working. Resume share. Okay. My screen is paused. Let's try again.
I'm just jumping back in here, Anne-Marie, to tell you what
Thanks.
we're seeing.
Okay.
I can see your screen now.
Yeah, I know. It's just not, it was working while we were on the mode of rehearsal, and now all of a sudden it's not working. All right, you know what? But let's just move quickly on. Maybe we can come back at the end. Introduce Gregg and from our colleagues, yeah, at YPTC. Let's see what happens.
Okay, Gregg, does that work for you? You good, Gregg? All right.
Yes.
Why don't you try and bring your presentation up, Gregg, while I introduce you. Thanks everybody for sticking with us as we work through some technical difficulties. I wanted to have, now we're not going to have Gregg's beautiful slide that Anne-Marie had with his all his wonderful credentials. I will tell you that Gregg works directly with ArtPride, and he's with the firm Your Part-Time Controller Incorporated, which has 7 offices now nationally, but in relation to New Jersey, they have offices in Philadelphia and Central Jersey in the Princeton area, and in New York City. We at ArtPride have been working with YPTC, as we affectionately call them, for over 6 years now. And they offer us services where we have a bookkeeper who comes in once a week and a controller who works with us for basically a few days a month, every month. They're fantastic. I can't say enough about what they do for ArtPride and how they keep us functioning at a high fiscal capacity. They are a relatively large firm, 200 staff people and 700 clients, tons of clients across New Jersey, which I know Gregg can talk about, including lots of nonprofits And I think, if I remember correctly, even some other clients besides ArtPride on the call today. And so they're here to talk to us about PPP, particularly loan forgiveness. With no further ado, I'll pass it over to our friend and colleague, Gregg.
Thank you, Adam, and thank you to everyone at ArtPride for giving me the opportunity to speak to everyone this morning. The webinar topic is the PPP loan forgiveness, accounting, tracking, reporting for nonprofit organizations. Hopefully my screen is advancing and you can see that, but as Adam mentioned, we are a firm of about over 200 professionals, controllers, accountants, CFOs, servicing many nonprofits. That is our core client base. We do have offices all throughout the country, but as everyone is working remotely, we have the ability to work with nonprofits no matter where they are. So before we begin the content, I do have a couple disclaimers because information is coming out quickly or sometimes not so quickly, but just so everyone understands that the information that we're going to be talking about today is our best understanding as of today. And every situation and every nonprofit's different. So the materials are really for educational purposes for you, but we advise everyone to speak to their accountant, consultant, financial or law department to get the information that is specific to your organization. So as I mentioned, we've done a lot of research to get a full understanding of where the regulations sit today. And here's a list of our sort of the points and sources that we've used. All of these links are on our website at yptc.com. So you can check out any of these if you want to take a deeper look. So when we're talking about the loan forgiveness, we were expecting to have more guidance, and per the original CARES Act, in section 1106 of the CARES Act, Congress said that they would have information and guidance out no later than 30 days of the act being implemented and released. That would put it at around April 28th. And of course, we're at May 8th, and the guidance has not come out yet. In fact, the AICPA last week, which is the American Institute of Certified Public Accountants, issued a letter to the Treasury and to SBA asking for guidance. But again, we sit here today with nothing new. So again, what we're looking at today is based on the current information that's available. The regulations and rules may change, they may not change. But the important thing is that everyone should be looking at the potential forgiveness amount and estimating what that will be. And we're going to get into that because you're going to need that information to make decisions. So the objectives today is we're going to learn how to estimate what the potential loan forgiveness would be, and also the proper accounting and tracking for reporting the funds that you may have received. So I think we have the ability to do a quick poll question, or actually two. The first one being, how many organizations attending today have applied for the PPP loan? So it's a simple yes or no. And we'll...
I was trying to vote and it won't let me vote.
The host and panelists cannot vote. We don't want to spread the results. So as you take a couple minutes to do that.
Yeah, I mean, I'm looking here.
I'll continue along.
Sure.
Are they, you got a good,
Well, it's a different view than we've had in votes still coming in, Jim says.
okay, no problem. So, well, let's dive into estimating the loan forgiveness, and we'll share those results with you shortly. So actually, before I talk about the loan forgiveness, let's talk about the loan. I suspect that we'll find that a majority, hopefully, of the organizations today have already applied for the loan. But for those who haven't and still interested, basically the PPP loan is developed by taking an average of the monthly payroll costs times 2.5. So if your organization had a monthly payroll cost of $100,000, you would get $250,000 in loan. We're going to be going through some examples today. So for purposes of today's discussion, we are going to be assuming that our sample organization applied for a loan and received almost $110,000. And again, we're going to be using these same numbers through the presentation to look at what our eligible loan forgiveness could be, as well as some reductions that may occur.
Greg, looks like we have the results. I think Jim's about to share.
Okay.
Here we go. 67% yes and 33% no. So pretty significant majority of the folks have applied for PPP.
Yeah, that's good. And for those who have not done so yet, but still may be interested, the SBA at SBA.gov, I believe their website is, they have a PPP lender finder. So if you're looking for a lender to work with on this, you can check out the website and find a lender for you. I will say that typically lenders are dealing with existing customers. It may be difficult to engage with a lender that you are already not dealing with. All right, so in our, the steps, really, there's 3 steps in determining or estimating what the loan forgiveness would be. Step 1 being that we're going to calculate what the total eligible cost for forgiveness will be. And then step 2 is we're going to have to calculate to see if there's any reductions to those eligible costs. And then 3 would be the net, compute that net amount for the loan forgiveness. Now, there is no guidance, again, waiting for guidance on the ordering of these steps, especially the steps involved in, or the ordering for the reductions. So keep in mind that if you change the order on how you do this, you might end up with different results. So you're going to want to run different scenarios. We're going to, for today's example, run this in the exact order that we're seeing right now. But again, that's just our assumption on how it's going to work. One of our overall themes is that this is something that's important to do right away. And I'll get into the reasons for that in a bit. But this is a complicated calculation. We tried to simplify it, but you're going to have to devote some time and some thought so you can properly develop your strategies. Okay, so starting off, step 1 is to total the costs that are eligible. So let's discuss a few, or let's define a few terms related to this. So when we're looking at the loan forgiveness, we're going to be looking at certain costs over the covered period, which that is the 8-week period beginning from when you first receive your PPP loan proceeds. 8 weeks is 56 days. So that's when we're going to have to be looking at our spend. And the eligible costs fall into a couple categories. Payroll costs, And payroll costs are defined the same way from when we applied for the loan. That's covered in Section 1102 of the CARES Act. And we're going to be looking at those same rules and regulations related to that for this purpose. There's also rent, utilities, and interest on mortgages. Now, these obligations would have to have been in existence prior to February 15th for it to be eligible. So in the case of rent, if you have a lease obligation that you entered into the lease after February 15th, those rent costs would not be eligible. The regulations mention interest on mortgages. That this is what we're again going with, but there has been some speculation that they're talking about any kind of interest again that was on obligations that existed before February 15th. So the actual regulations, the wording is here. So what they're looking for is that eligible recipients shall be eligible for forgiveness of indebtedness on covered loans in amount equal to the sum of the following cost incurred and payments made during the covered period. Again, here's those terms we mentioned: payroll cost, interest on covered mortgage obligations, and payments on covered rent and utility payments.
Greg?
The phrase here is cost incurred and payments made.
Hey, Greg, we had a couple questions that are that popped up here. I'll throw in just because they're, I think, relevant to the slide you're talking about. What's covered? Are software licenses considered covered utilities?
I do not believe so.
Okay.
So we're talking utilities in traditional sense, although they did throw in telephone in that definition, I believe.
Like internet, your ISP.
I believe so, yes.
Okay. And then what about contracts for facilities maintenance?
When they mention rent, I think they're just talking about the rent. Now, if you have, that's an interesting topic. I'd have to look a little further in whether part of the rent payment includes CAM, common area maintenance. I'm not sure if that might have to be segregated out or not, but that's something I can follow up on.
Okay. And one more before I let you go right back. What is the definition of payroll dates?
So that is perfect lead into this discussion.
Okay,
so,
great.
The cost incurred and payments made is what we're talking about. And I think that's at the heart of that question. So for the cost to be eligible, they have to be incurred and paid within this 8-week period. Payroll is a great example. Today is May 8th. I'm an employee of YPTC. I received a paycheck today. It was paid today. However, the pay period that I'm getting paid for occurred 2 weeks ago. And a lot of times we have a 1 or 2 week lag in payroll expenses from when they were earned to when they're being paid. So both parameters, incurred and paid, have to fall within that 8-week period. And that's definitely going to be a big strategy. And we're going to talk about a little further in a couple of minutes. But both those conditions have to exist.
And those dates are based off of the date of the payroll, like the check date of the payroll.
The check date of the payroll and the payroll period covered. So the payroll period covered is when it's incurred, and the check date of the payroll is when the payment is made.
Thanks, Greg.
Yes, I thank whoever asked that question because that was a great lead into this point.
Karen Lanning gets the credit for the segue.
Great. So this is a great little schedule to get an overall understanding of what we're looking at. So let's assume that we got our PPP money on April 26th or April 27th, which is a Monday. We have 8 weeks or 56 days for our cost incurred and our payments made. And you can see here, we broke this down into the 8 weeks. So our first week ending is May 3rd, and our end of the 8-week period is June 21st. And the expenses that we're going to want to accumulate are our payroll cost, the benefits paid for healthcare and retirement, employer portion of state and local taxes, rent, utilities, and interest. So we need to have the payroll periods between April 27th and June 21st. So they have to be the eligible pay periods, and the check dates of the payroll have to be between those dates as well. So as we get to the end of our 8 weeks, and we have a pay period that say ends on June 20th, that maybe normally you'd be paying June 27th, you're going to want to make that check date June 20th or June 21st. That's the kind of strategic planning we want to be considering. So let's take an example of what this would look like. So our first step is, again, to calculate the eligible costs for forgiveness. So let's assume, and we'll get into sort of the details, but our actual payroll cost paid and incurred in this 8-week period is $77,500. And our other non-payroll costs, rent, utilities, and interest, that's another $28,000. We're going to be looking for forgiveness of $105,000, almost $700. Now notice that is slightly below our original $110,000 loan. Let's see why. So when we look at calculating what our payroll costs are, we're going to take the gross payroll, I guess, again, incurred and paid in that period. We will have to reduce it if we have compensation for any employee earning in excess of $100,000 per year. And when we made our original loan application, we weren't allowed to include compensation over $100,000 a year. So again, we're using the same definition in both cases. And if the organization is taking credit for any number of other relief and emergency credits that are available, one is the Families First CARES Relief Act. If we're paying emergency family or medical leave or sick pay under that and taking a credit for it, a tax credit, we can't also use those same dollars for our forgiveness calculation. So that's really how we are sort of not in line with what we originally applied for versus what we're now asking for forgiveness. But in addition to the payroll cost, we are also including the healthcare benefits, retirement benefits, and the employer share of the state and local taxes. That
Greg, we had a question on this just real quick. So the insurance there, the health insurance can be included, but not general liability or workers comp?
No, this is definitely not the liability insurance. The workers comp is one of those sort of lack of guidance on, but the theme is the employer portion of employee cost. That could go either way. Again, there's a lack of guidance on that. Okay. But liability insurance, definitely not, because that's not in sort of to the benefit of the employee.
Right. And here, clearly, health insurance definitely in.
Health insurance, workers' comp really isn't to the benefit of the employee. So to be conservative, I probably would not include that. But you can see how the healthcare cost, the retirement contributions, the employer portion, and of course, when we say employer portion of state and local taxes, that's really the employer portion of the unemployment taxes. It's not on income taxes. It's really the unemployment taxes. They all benefit the employee, and that's why they're included in this calculation.
Okay.
So that's where we get our $77,000 or so, and along with our $28,000 of non-payroll costs, that's how we got to our $105,000. Our next step is calculating potential reductions. And there's three potential reductions to that $105,000. There's a non-payroll cost ratio reduction, there's a headcount reduction, and a wage reduction. Let's take a look. So the SBA guidance says that no more than 25% of the loan forgiveness could be attributable to non-payroll costs. That's the interest, the rent, and the utilities. So therefore, 75%, at least 75%, have to be from payroll costs. Back to our example, the $77,000 happens to be 73% of the $105,000. So we're looking at a potential reduction of about $2,000. Now, we can do a little shortcut and work backwards. If we know that our payroll is 77,569 and we divide that by 0.75, we're going to come up to a maximum eligible cost of $103,425. But again, we have to have at least 75% of our forgiveness be attributable to the payroll cost. That's the wages, the benefits, and retirement, and the unemployment taxes. The next potential reduction is headcount. And the regulations require that we maintain the same headcount before stepping into this receiving our funds as during the period that we're using the funds. So headcount is based on a term called full-time equivalent employees. So a typical full-time equivalent employee is 30 hours, but we're going to add up all of our employees, and we can combine a couple of, let's say, 2 employees that have an average of 15 hours, they would become 1 equivalent FTE. And we're going to compare our headcount, our FTE headcount, so it's an average of our headcount during the 8-week period. And we're going to sort of develop a ratio and divide that over a base that's the either based on the headcount from February 15th of 19 through June 30th, 19, or January 1st, 2020 through February 29th, 2020. And we get to choose whichever calculation is more beneficial to us. They gave us a little gift there. So for example purposes, let's say we had 8 employees and we calculate an FTE count of roughly 6.4 FTEs. And let's say when we look at our potential base, our first option was looking at a headcount from last year of, it was 8.5 FTEs, and looking at the headcount option 2 of this year, it came to 7.25 FTEs. That's the more advantageous one. We're going to use that. So the ratio of 6.4 over 7.25 is our headcount is roughly 88.4% of what it was, which means we now have to reduce our potential loan forgiveness cost by roughly 11.6%. This is an important factor or important consideration. If we are estimating and scheduling this out and we see that our headcount is going to fall below what it was and we're going to have a reduction, we have the opportunity to restore the headcount. And we have until June 30th of 2020 to restore the headcount. If we can bring it back up over 7.25, we don't have to reduce our loan forgiveness by this calculation. Again, another reason why it's important to be estimating the potential forgiveness now, so we have the opportunity to make decisions and corrective actions. The third reduction was the wage reduction. So for employees who don't have compensation over $100,000 and don't have a residence outside the United States, we cannot, for those employees, we cannot reduce their salaries more than 25% from what it was from the prior quarter. If we do, we have another potential reduction. So we're going to look at for those employees, look at what their compensation was last quarter. Now, a quarter is 13 weeks, and we're comparing it to 8 weeks, so we're going to have to do a little math to convert that, what we call right sizing. And if we determine that employees' wages were reduced by more than 25%, we're going to have to reduce our estimated loan forgiveness by that amount. So for illustrative purposes, let's say we did this calculation, we came to $1,275. Like the headcount though, if we're able to restore those wages by June 30th, 2020, again, we don't have to take this reduction. When our step 3 is to add these numbers together or take our eligible costs, reduce it by our potential reductions, and we get our loan forgiveness amount. When we do the math, we see that we have $90,000 in potential forgiveness. We started with $105,000. We took our non-payroll cost ratio reductions. We took our headcount reduction and a wage reduction. Our original loan was almost $110,000. So we're estimating that we're going to get $90,000 in loan forgiveness, but also that means we're going to have roughly $20,000 in loan proceeds that aren't going to be forgiven. We're going to have to pay those back. The payment terms set forth in the PPP regulations are a 24-month loan at 1% interest. The payments are being deferred for 6 months, and there's no prepayment penalty, so we're able to pay these funds back whenever we want with no additional cost. So you have a choice whether, if you have a portion of the loan that's not forgiven, whether you want to pay this over the 2 years. You can pay it all at once to avoid the interest. Again, the interest is 1%. Maybe you don't want to do that. But again, the overall theme is let's take a look at this now so we can make decisions on what we want to do. Oops, a little fast there. All right, so that brings us to proper accounting, tracking, and reporting of the PPP loan funds. And I could summarize this in 3 simple words. Document, document, document. We're going to have to document everything that we're doing. So eligible recipients are going to have to file for an application for forgiveness with their lender. And what the lenders are going to be looking for is documentation on all the payroll cost information, employee headcounts, the payroll itself, the benefits, the invoices and bills and checks for paying the benefits and the retirement contributions, the unemployment tax, as well as the interest if you're claiming that, rent, and utilities. We're going to have copies of the invoices and copies of the canceled checks. Also, if you recall, when you made the application for the loan, you had certifications that you made. You know, that, again, the same thing's going to happen. The documentations presented are true and accurate. You use these funds to retain employees. That was, and I should say what PPP stands for is the Payroll Protection Program. These funds were not supposed to be used for general operating costs or to make up for lost revenues. This was to be used to retain your employees. So you're going to be making a certification that that's what you used it for. So I highly recommend speaking to your board or speaking to your attorneys on making that certification. Keep in mind that the SBA has the right to audit recipients to make sure that they use those funds properly, and that was the intent, their intent. Making some sort of memo in your records is a great way to sort of get the ball rolling on this. Again, maybe speak to your board and your attorney about this, but maybe some kind of memorandum where you describe why you think the current economic uncertainties made the loan necessary for your organization. I'm sure you've heard in the news some public companies that got got these funds and got a lot of bad press because they had other sources to help them maintain their, their cash flow to pay their employees. If that was the case, they weren't supposed to apply for the loans. The IRS or the SBA allowed people to return the funds if they sort of had regrets or realized maybe I didn't need these funds, and they gave them an opportunity to return the funds without penalty or further scrutiny. So a little bit on the accounting side of how we're handling this. When you receive your PPP funds, you're going to be treating this as a loan, even though you're hoping that all or some of it's going to be forgiven. We're treating it as a loan to start. If and when you get forgiveness, we will then reclassify the portion that's forgiven to income. Again, there's a lack of guidance on what that income is going to be considered. Is it other income, other miscellaneous income, or is it going to be a contribution, almost like a grant? We don't know yet. As we're spending the money, well, let me back up. We advise that when you receive the funds, you open up a separate bank account to hold these funds. As you're spending the money, you don't need to write checks out of that account. You can pay those expenses from your operating account and then simply transfer the funds to reimburse your operating account. Again, on the accounting side, when we spend money, we classify it to a type of expense. And like you would do with when you're spending grant funds, you also tag the funding source. And we're going to want to do the same thing with these expenditures as well. In your accounting software, depending on what you have, those funding source codes could be considered a segment of your chart of accounts, or if you use a system like QuickBooks, it's called a customer job or a project. But the important thing is that we need to track the spend, the funding source of the spend. If we have loan forgiveness, and you're going to have expenditures that create this loan forgiveness, it could put you into a situation where you're now subject to the single audit threshold if you receive more or spend more than $750,000 in federal expenditures. If you haven't been subject to the single audit before, it's an additional level of audit that's done by your auditors at the same time as your year-end financial statements. And you're going to need documentation for all your costs for that purpose as well. So documentation, that could be in the form of work papers and spreadsheets. This is a great sample of keeping track of payroll costs. So here we have for all of our employees, for all of our weeks, all the different components of what our eligible payroll costs would be. And even a summary sheet of all of our costs incurred. So we have our payroll costs and our other non-payroll costs, again, laid out by category and by week. Some other reporting things to consider is for our year-end audit statements, depending on when your fiscal years end, whether it's before you spend these funds or receive them, or if it's afterwards, there's probably going to be some kind of subsequent event disclosure that's going to be needed in your financial statements to discuss the effect of COVID-19. And to take it one step further, there may be a question on whether your organization can continue with as a going concern, and that's another footnote that gets added to your financial statements. If you're in that situation, you're going to need to estimate and prepare projections on how maybe the PPP funding could help, or maybe it doesn't help. But you may want to delay issuing those financial statements if there's a going concern situation to see maybe we can avoid that disclosure by the use of these PPP funds. Two other considerations before we wrap up. One is, as I mentioned before, if you take advantage or if you've taken advantage of other emergency relief opportunities, such as the emergency FMLA payroll credit, paid or sick leave credit, employee retention credit or Social Security tax deferral credit, or that's not really credit, but you're deferring your employer portion of the Social Security taxes, that's going to affect your loan forgiveness calculation. So you have to keep that in mind. And finally, we have to be always thinking about that we cannot be double dipping. We cannot use our PPP funds for these payroll costs and use other funders' dollars for those same payroll costs or those other non-payroll costs. So if you have a funder that's paying for payroll, you're going to want to go back to them and ask them to maybe extend their grant period to fall outside of the 8 weeks, or maybe reallocate to costs that are not eligible under the PPP forgiveness. But we can't be using those, we can't be covering those costs with PPP funds if somebody else is covering those. That's what we call double dipping.
Greg, I had a few questions for you as you have the resource page up there, if that's okay. Take a sip of your coffee. It's okay. Go
so
for it.
I was going to say, you can find these on our website, yptc.com, and these links can take you to these resources.
And of course, we always are going to have this up on the ArtPride COVID page. So if you're working with someone, if you miss something, there's a ton of great information. So I have basically 3 questions here because a couple of folks asked sort of the same question. First one's around seasonality of employees. So whether you're an arts organization that has like a 4-week lag in summer programming between sessions, or you're a theater company that has reduced FTE during the summer due to seasonal nature of the business, guidance and information on seasonality during this period.
Yeah, there is. And part of the original loan forgiveness or the loan application, again, the same rules apply to both the application and then the forgiveness. There is guidance on calculating the FTEs, taking into account seasonality, especially on the request. That on the loan forgiveness, that's why they gave us that sort of 2 different options on our base. But again, even if we don't meet the headcount requirement right now, we do have until June 30th to restore that headcount.
Great. So the talking about June 30th, and I'm jumping around here on a couple questions here, but is there talk about the end date, the June 30th end date, moving due to the lateness of some funds being dispersed?
No, and that is an excellent point. As we know, we have 56 days counting backwards. I think we're right up against it right now, probably. So if you receive your funds next week or the week after, you might be falling out of the June 30th, and your 8 weeks may be cut short. Now, I will say that seeing how quickly the first sort of influx of money went in about a week or maybe 10 days, the second issuance of the money came out about a week later. I don't know how much funding is still available. So although I would say that it's still worth to try if you haven't applied yet, I don't know that it's likely to be funded at this point. I just don't know how much federal dollars are left.
We're going to pop up a poll real quick while we answer this next question, which is we're going to just see how many folks have already gotten the PPP. We meant to throw that up earlier, sorry. But while we're talking about this, all right. So the next question that came in was about is there guidance on FTE calculations as it relates to gig workers who only work if there's an event? Technically, these employees are not laid off, but because we cannot operate, we do not have work for them.
That is, yes. So an interesting situation, because if we look into our headcount and we're saying that when we're looking into our headcount period, we're comparing the headcount today or during our 8-week period versus those two other periods. So if they didn't work in those other two periods, that's not going to account against you. And the same thing with the compensation. So if they weren't paid last quarter and they're not being paid this quarter, again, I don't think that's going to have a negative effect on the calculation. But I would almost say that they may fall into that seasonality definition as well.
So just says, I guess, of 27 respondents, 74% yes, and 26% no. So a lot of folks who've gotten it so far. All right, so next question. We got a few left here, and then we're gonna move on. I know we're going a little long today, everybody, but I think this information is really helpful. So thank you, Greg. From Pam Brand at Symphony and C, do you feel it is better to seek loan forgiveness early, or to wait a while to see what is actually included in the overhead costs, as well as have the opportunity to see how stringent the review process is? There was someone else who asked sort of a similar question about when we can request a forgiveness application.
So, unfortunately, like so many of the questions, there's no guidance yet. The banks are still working out with SBA the process. My thought, and this is just my opinion, I don't know that applications for forgiveness are going to be available prior to June 30th. Maybe as we get towards the end of June, they become available. But again, we don't need the application yet. We can start sort of mapping out and estimating what we think that would be, what that would look like, to determine the best course of action. And that's really the main purpose, or the main theme of today's webinar is, let's start calculating this now. Let's sort of forecast and project out now what the forgiveness could be. If you can make that assumption, or doing this calculation, and you come up with, I'm really not going to have a lot of payroll costs that are going to be covered, I'm probably going to not have a lot of forgiveness, you may decide that I'm going to pay this money back and not worry about applying for forgiveness. But again, we have payment terms of 1% over 24 months, no prepayment penalty. So that may be the course that you decide to take.
Right.
Certainly don't want to be waiting until the application process comes out to start keeping track, obviously, and planning.
I know I'm going to be going back and looking at our loan forgiveness worksheet that Jennifer and our YPTC team sent over to me, and I glanced over. Now I'm going to go back with this information and look closely again. It looks like we have at least one or two more questions. So the timing of the loan origination changes the estimates that someone provided upon application. When they applied, they were in their spring session, their full 6 weeks session, and when the funds arrived, they're now in their summer session that is payroll covered by grants, and those grants only cover that summer session. So does that mean they should consider returning the monies? And I think this has to do with the double dipping that you were talking about earlier.
Yeah. That's a great example. So speaking to my decision tree would go, I'm going to go back to that funder first and see how else I could use those funds or change it, change it up a little bit. But yeah, we cannot double dip and get the loan forgiveness.
Right. I know a lot of funders are having more flexibility. And so if you find yourself in that situation before you return the money, that's definitely a conversation you want to have. So if a funder was putting money towards payroll and they can say, you know what, you can use it for general operating this time because of these extenuating circumstances, that can be a way to work.
Absolutely. And also if it's, specific program, it may not be covering all the employees, maybe only one or two or three, or, the employees involved in that program.
Right.
Our PPP funds are for all employees. So you may have that 75%, 25% ratio issue, but at least there's going to be some loan forgiveness in that situation.
All right,
Greg,
we're going to take one more question.
I know you got one more question. Could you stop sharing your screen for a minute, Greg?
Absolutely.
Thanks.
So one more question here. How does the $10,000 EIDL funding impact the PPP loan?
The great news there is it does not. So another opportunity was the EIDL loan, and that is through the SBA. And you do that directly through the SBA's website. You apply for an EIDL loan. When you apply for the loan, they are going to give you, whether or not they approve your loan, they're going to give you $1,000 per employee up to $10,000. Although the SBA does not lend to nonprofits, they never have, so they can't call this a grant. But I spoke directly to the New Jersey director of the SBA, and he said, this is basically a grant. This $1,000 per employee up to $10,000 treat it like an unrestricted grant. You can use it for whatever you want. It does not affect your loan application or your forgiveness calculation for the PPP. However, when you have to apply for the loan to get this maximum of $10,000, if it turns out that the SBA is also going to give you the EIDL loan, the probably best course of action is to reject that, because that loan under the EIDL program will affect your PPP loan amounts and forgiveness. So you want to get that $10,000 grant, and you do not want to accept the loan. The EIDL loan is a 30-year loan, and for nonprofits, the interest rate is 2.75%. Obviously, a 1% loan from PPP is a better deal than a 2.75% loan from EIDL. Granted, they're both coming from the SBA.
All right. I think we're going to throw it back over to Anne-Marie to finish up here. Gregg, thank you so much. This was a ton of information. Like I said, it's going to be up on the ArtPride COVID resources page later today. But just thank you. This was terrific. And thank you to everybody. It looks like essentially everyone stuck around. So I know, Anne-Marie, looks like your screen's working. We're going to throw it back to you.
Thanks. Thank you, Gregg. That was really incredible.
Great.
Quick run through of a really very, very complicated program. So really appreciate it. And we have heard word of more groups in round 2 receiving PPP, so we're very encouraged. This is up on the Americans for the Arts website. So if you are receiving CARES Act funding, they're trying to track that. So please indicate, and the link is there on the bottom. I actually shared some other information that they've been tracking on data related to nonprofit arts organizations and arts and creative workers. So you can find that information at the link at the bottom there as well. And you can also sort it by zip code, and you can sort that information, the data by state as well. So this is something that just showed up this morning. I want to thank Michelle at the Arts Council for bringing it to my attention. A Quinnipiac University poll about comfort to attend events, and you can see where concerts and sporting events lands in this. There'll probably be more information coming shortly on this as well. Also bring your attention to the fact that the Americans for the Arts and the Arts Action Fund page, that big table that we shared about all the different phases of the CARES Act and how it relates to arts organizations and arts workers is being updated. So the one that we had from the previous webinar has been updated, and you can go to this page to get that. It's very comprehensive, and you'll be able to sort through that to find information. This was also in this week's paper with regard to, in 1 week, the increase of PPP loans that has been noticed. I had what you can do is please stay in contact with your congresspeople. Let them know what's going on. There are considerations for improvements and extensions of PPP going forward. So let them know the problems that you've run into. Let them know the benefit that it's given your organization is really, really important for you to stay in contact with them as they consider the next phase of CARES. There's our nice picture and bio of Gregg. I want to remind everybody that May 20th, there's a webinar of engaging audiences in the COVID area for Jersey arts marketers. Registration is still open. Please go to the ArtPride website to register. Stay in tune with the page. We keep updating the resources every day, if not every other day. And also the virtual events are located at Jersey Arts at Home, Jersey events. Please check out what our colleagues are doing around the state and share the information as much as you can. And then, you can always reach us. Thank you for joining us. Everybody stay safe and well. Happy Mother's Day.
Yes, happy Mother's Day to all the mothers out there, including you, Anne-Marie.
Oh, thanks, Adam. And then please just complete our exit survey, and we'll be back next week. Thank you, everybody.
Yeah, thanks, everybody. Thank you to Gregg and YPTC again. Stay well, everyone. We'll see you next week.